Come on in. David Bahnsen, the Bahnsen Group CIO. David, welcome to the program. Oh, you're the author of a book. I got that in. Crisis of Responsibility. I hope it's selling well, young man.
Doing great, thank you.
I want to know where you think this market ends the year. 24,000 now. Where at the end of the year?
The problem is that there's too many variables to give a sensible answer, and so what we have to do is continue to look at what's taking place to drive market prices. This tariff thing is a disaster for markets. The tax reform and the continued benefits from it are going to actually push more impact in a positive direction for markets throughout the year. So there's push-pull forces going on.
Okay, but answer me this. We've had a whopping great big bull market, a huge run-up, I should say,
right,
from the election till January the 26th.
That's right.
Is that huge run-up over?
No, I don't think so. And one of the most encouraging things is how overreactive the response has been. So many people pulling money out of the market, the pessimism coming in so quickly. As a contrarian, that's generally a very good sign.
So is this a flush out?
I think it's a flush out of weak hands, but again, there is a volatility factor that is different than fundamental movement. The volatility is being driven by the fact that, frankly, there's a lot of volatile things happening. There's no certainty around the trade and tariff issues. I think company earnings are going to come in now for first quarter results starting in April and reinforce the benefits of tax reform. It's a very positive sign. But when you look at the monetary policy side, which is what people probably should be talking about, and then this whole new thing over the last 6 weeks around trade and tariffs, there's plenty to justify the volatility.
I think most of our viewers who are not, if I say, they're ordinary, everyday people who have some money on the side and they put it into stocks. Yeah. A lot of them have put it into the tech stocks because they've done so well. Well, those tech stocks are down, significantly down. It would take a strong stomach, wouldn't it, for you to tell our viewers, get back in there, buy some more Amazon, buy some Microsoft.
Don't worry about my stomach. I would tell viewers whatever I thought was the right thing to do. And first of all, like you said, they got in because what? What you said, because they had done so well. That's the worst reason to ever buy stocks, because they just got done doing well. We don't invest with a rearview mirror. Looking forward, where is the value in the market? Do I believe the value is in the Facebook, Amazons, Googles? Of course not.
No,
not even close.
Not even close?
Not even close. Now, that doesn't mean they won't go higher. It doesn't mean that sentiment fully changes. They have a great technical support, okay? There's so much ETF ownership that there's automatic buyers that create a bid, but it cascades the other way. Fundamentally, this socio-political revolt against cool, big tech is in early innings. I'm confident of that.
What would you buy? Just tell our viewers, what would you buy?
So we talk all the time, you look at what is most distressed that has fundamental value. We're dividend growers.
I want a name.
I'm giving you several names. First of all, GlaxoSmithKline today walking away from the Pfizer deal. The best news I've gotten this morning, besides the possibility, I don't really think it's going to happen, that President Trump will actually veto this garbage spending.
So you like Glaxo?
Love Glaxo. They have a 5.8% dividend that would have been threatened if they went forward buying Pfizer's unit. They were going to lever up their balance sheet to do it. They walked away. We're happy about that.
Glaxo pays me, buy it today at this price, Glaxo pays me 5.8%, and that's a secure dividend. No problem with that.
Well, secure dividend is a relative term, but it is covered by free cash flow, which is what we do, we monitor, and yes, the answer is yes.
Give me another. Give me a stock.
I think that
big name
this requires patience.
That pays me 6%. I want 6%.
Well, then I'll give you an 8% name with Blackstone. We talked about this before, ticker BX. Blackstone, again, covering their dividend from free cash flow, the best run asset manager I've ever observed in my career, both alternative and real estate credit exposure, the absolute cream of the crop in the name, paying an 8% dividend.
See, that's what I wanted. 8% from a big name company with cash flow to back it up. Love it. David, you're all right. Thanks for joining us on a very big day. We appreciate that.